Hello everyone! Today we will talk to you about finance. This lesson will be about the cost of capital. There are three capital components, namely debt, preferred stock, and common equity. Firm's weighted average cost of capital, or WACC, WACC. As we can see in this formula, the WD is the target weight of debt, the WP is the target weight of preferred stock, and the WC is the target weight of cost of capital. The RD 1 minus T is the after-tax component cost of debt. The RP is the component cost of preferred stock, found as the yield investors expect to earn on the preferred stock. The RS is the component cost of common equity raised by retained earnings or internal equity. The factors that affect the WACC are interest rates in the economy, the general level of stock prices, and tax rates. If interest rates in the economy rise, the cost of debt increases because the firm must pay bondholders more when it borrows. Similarly, if stock prices in general decline, pulling the firm's stock price down, its cost of equity will rise. Tax rates have an important effect on the firm's cost of capital. Now we move on to the cost of debt. It is defined as the return that lenders require on the firm's debt. There are two types of cost of debt that we must know. First is the before-tax cost of debt, RD, which is the interest rate a firm must pay on its new debt. The second type of debt is the after-tax cost of debt, RD 1 minus T, which is the relevant cost of new debt, taking into account the tax deductibility of interest, which is used to calculate the WACC. This is the interest rate on new debt, RD, less the tax savings that result because interest is tax deductible. We will now learn the cost of preferred stock, RP. It is the rate of return investors require on the firm's preferred stock. It is calculated as the preferred dividend, DP, divided by the current price, PP. This is the formula. We will now learn the cost of retained earnings. We must first understand that the cost of debt and preferred stock are based on the returns that investors require on these securities. Similarly, the cost of common equity is based on the rate of return that investors require on the company's common stock. We use the symbol RS to designate the cost of retained earnings and RE to designate the cost of new common stock or external equity. We must recall that if a stock is in equilibrium, its required rate of return must be equal to its expected rate of return. Further, its required return is equal to a risk-free rate plus a risk premium, whereas the expected return on the stock is its dividend yield plus its expected growth rate. There are three ways to determine the cost of common equity. First is the capital asset pricing model. Second is the dividend growth model. And third is the owned bond yield plus risk premium. The most widely used method for estimating the cost of common equity is the capital asset pricing model. Here are the steps you need to follow. Step 1. Estimate the risk-free rate or RRF. Step 2. Estimate the stock's beta coefficient, BI, and use it as an index of the stock's risk. Step 3. Estimate the expected market risk premium. Thus, the CAPM estimate of RS is equal to the risk-free rate, RRF, plus a risk premium that is equal to the risk premium on an average stock. The second way to determine cost of common equity is through the dividend growth model or DFC. We will use this equation. We can see that investors expect to receive a dividend yield D1 over P0 plus a capital gain G for a total expected return. Lastly, we can use the owned bond yield plus risk premium to compute for the cost of common equity. As the name states, KS is computed by adding the bond yield KD and the risk premium RP. We now move to the cost of new common stock. The formula used for this is the following. Here, F is the percentage flotation cost required to sell the new stock. So P0, 1 minus F, is the net price per share received by the company. In understanding all of this, we now discuss risk and the cost of capital. Projects should be accepted if and only if their estimated returns exceed their cost of capital. Thus, the cost of capital is a hurdle rate. A project's expected rate of return must jump the hurdle for it to be accepted. This graph illustrates the trade-off between risk and the cost of capital. Thus, Firm L will accept a typical project if its expected return is above 8%. Firm A's hurdle rate is 10%, while the corresponding hurdle rate for Firm H is 12%. We will now solve some problems on the cost of common equity. If the risk-free rate is equal to 7%, the risk premium is equal to 6%, and the firm's beta is 1.2, what's the cost of common equity based upon the capital asset pricing model? Using this formula, we will get the answer of 14.2%. For our second problem, if the dividend is $4.19, the stock price is $50, and the growth is 5%, what's the cost of common equity based upon the dividend growth model? Using this formula, we will get a common equity of 13.8%. We will now look at some global variations in the cost of capital. For US firms to be competitive in world markets, they must have capital costs similar to those their international competitors face. In the past, that US firms were at a disadvantage. In particular, Japanese firms enjoyed lower costs of capital, which lowered their total costs and made it harder for US firms to compete. Recent events, however, made considerably narrowed cost of capital differences between US and Japanese firms. The US stock market has outperformed the Japanese market. Thank you, and we hope you enjoyed this lesson of cost of capital.